Hello, this is Brandon Wolfe. I'm submitting this as my final project for financial analysis, DSA 5303. I will be searching the New York Stock Exchange for flash crashes which no one has seen before, and doing some analysis on how to use such series of flash crashes as a training data set to create a model. So in this paper, I'm going to be improving and extending the results of two research papers, Galoob et al. 2012, as well as Pragma 2017. Both of those papers did the kind of flash crash search, in this case on a couple of months worth of data, and in this case on several years worth of Forex data in order to find flash crashes. I'm extending on these two works by proposing a new definition for flash crashes, which would improve on them both. So I just want to quickly motivate why you would talk about high-frequency trading. As you can see here, high-frequency trading has risen since 2004 to become really a large share of the volume, the total volume of trading that goes on the stock market. Between high-frequency trading and passive trading like ETFs, more than half of today's trading is either high-frequency trading or passive trading. There's a quote here from the head of JP Morgan's quantitative team using this information and drawing the conclusion, which I also draw, that if 60% of equity assets or greater versus more than 30% a decade ago are either passive or quantitative, and only 10% of the trading volume originates from fundamental discretionary trades, what that means is that the narratives that we tell each other about what causes a particular market move or the reasons for what's going on in the market, while those explanations are all over the place, traders are not making their decisions. The majority of trades are being made by high-frequency traders that don't even have macro data like the jobs report or inflation, even within their scope. And so the majority of equity investors today don't buy or sell stocks based on stock-specific fundamentals at all. These high-frequency trades and the reasons they have for trading have really taken over. So for example, right after the flash crash that occurred on May the 6th, 2010, there was a huge variety of explanations for why that would have come about. In the case of a Brexit flash crash, it was blamed on Twitter feeds. So there was apparently an algorithm that had heard news about what was going on Twitter. One of the results of this research is that flash crashes happen constantly. They are not related to news items, and that if you're going to find a reason for flash crashes, the explanations that people give on market fundamentals just aren't the case. High-frequency trading algorithms don't have that kind of information even within their scope. What kinds of things do trading algorithms have in their scope? This particular report comes under this heading. This is what I thought of as quantitative. You use historical stock, in this case tick data, in order to create a model, and then that model sends a price signal. The type of algorithm that is responsible for two of the flash crashes that I find in a moment here is what's called electronic market making. So the flash crashes, in a couple of cases that I observe, there's a bad trade, a fat finger trade, someone who accidentally pushed the wrong button on their computer, and then electronic market making came in and used the bid-ask spread from that trade in order to make money via arbitrage, and that led into a cascade. This is a table of the most famous flash crashes. In order to determine what should go on this kind of a table, being famous is not a good criteria. So there should be a list of thousands of these flash crashes, because flash crashes are constantly happening daily, probably between, say, 5 and 6 a day on a particular single stock. And for example, so defining flash crashes doesn't necessarily have to do with their speed. So this is the first thing that was ever referred to as a flash crash that I could find. There was a crash back in the Kennedy administration that was related to the Cuban Missile Crisis. The reason I would not call that a flash crash is not because it happened over such a length of time. So what's novel about these flash crashes is not how quickly they occur. It's because a flash crash immediately rebounds to its previous value. In other words, there is a fundamental value that these assets have, and that fundamental value eventually regains a foothold. But the flash crash temporarily knocks off huge percentages of the value. In May of 2010, it was about $1 trillion that was taken out of the market temporarily, and then back again almost immediately. So it's the rebound that makes something a flash crash, not necessarily the speed. In addition to defining what a flash crash is, I ran into several indicators that you would use to build a model once you have a training data set. One of them is the VPIN. This was proposed as a substitute for the VIX as a volatility index that could predict flash crashes back in 2011, and has been used since then. It's somewhat controversial. What you could do once you have a training data set of flash crashes, put in any indicator that people have claimed is a cause of flash crash, and then if it improves your model, then it is an indicator, and you would be able to measure which of the proposed indicators was actually superior by ranking the importance of the indicators. So that's why you would want a training data set of the type that I'm creating. Another one proposed by Aldridge in 2014 is the length of runs in a particular direction. Aldridge argues that if you have a run in one direction, that creates a vacuum in the liquidity, and that the other side of the order book has a problem once that liquidity has eroded, and therefore that runs of this sort would be predictive of a flash crash. If that's true, then it should be that runs improve the model. Another one is correlations. So not necessarily the correlation of the entire market. Obviously, the correlation of the entire market would increase during a crash because everything is going down, but it would be unusual for different markets, unrelated things, to be correlated as they go up and down. So intercorrelations between sectors could be predictive of a crash. For example, here, the correlation between utility and financial ETFs underwent a sign change from being negatively correlated to being positively correlated immediately prior to the crash in February of this year. So there is a potential you could just, again, throw in any intercorrelation that you wanted to between VIX and SPY, for example. That should do a good job of predicting the type of crash that happened in February, and then rank the importance of the correlation for flash crashes, but you need to have a data set of several thousand of them. So here is how I obtained the high frequency data and then analyzed it. High frequency data is difficult to get a hold of. Companies today don't make as much money on individual trades because they've gotten cheaper, and so they're very possessive of their data, and selling their data is quite expensive. The only sites that I wound up being able to get a hold of for tick data, for microsecond length data, was a Norwegian site called Netfonds. Unfortunately, they only have data for the previous 5 days. So here I created a calendar for business days and called the previous 5 business days. And then they also only have ticker data available for the New York Stock Exchange. And even in that, there are several symbols that are missing. So the next thing you would want to do is download the available exchange symbols. And that's what I'm going to be looping through. I'm going to be looping through first the 5 days that are available, and then the 1,600 symbols that are available. It took about 2 days to process the data. So here is a pseudocode. In the actual code, there's a lot of cleaning up of the data and putting it into a data frame that made sense. But basically, you make a list for the 5 days and the stocks that you intend to loop through here. Download the data, load it into a data frame. This is where you determine the price differential. In other words, is the trades, are they increasing or decreasing? There's a Boolean variable for whether or not they're increasing or decreasing, and then this defines the length of the run of increasing and decreasing. That's necessary for defining a flash crash according to Galoob. And then this here is the meat of determining if a particular run is a flash crash. These are the conditions, or this is where the definition of a flash crash goes, and that is really the major conclusion of this research, is what this definition should be. So the definitions that were in the two papers that I'm expanding on have some deficiencies. The definition of a flash crash via Nanex and Galoob is that has a run for 10 consecutive trades, and that seems kind of artificial. It winds up being artificial. The price changes have to occur within 1.5 seconds, which seems fine, and the price change has to exceed plus or minus 0.8%, so I find that to be a little bit too small. One of the problems with the Nanex and Galoob criteria is that it includes quite a bit of morning volatility. So I identified 19 flash crashes, and 13 of them were just morning volatility. So after hours, there's trading, and when people wake up in the morning, the market has to find equilibrium with its current value, and that leads to a lot of volatility. That volatility is identified to a great extent as a flash crash. So you either need to identify just ignore the first 35 minutes, or in your definition of a flash crash, instead of being a price change, then it needs to exceed some multiplier of the normal volatility at that time in the day. So I wind up just saying that the first 30 minutes should be excluded. Here's another potential flash crash that's identified by that criteria. This is obviously, well, not obviously, but I would not call this a flash crash. It's put a flag here on 10 consecutive trades, but that's just part of the normal volatility. Again, I've disqualified the majority of the crashes that were given by the Galoob criteria, and what that means is that by about a factor of 10 or so, the flash crashes that Galoob announces or claims aren't actually flash crashes. And so it's difficult to see what conclusions that paper drew, which would still be valid. So their data set is just full of a bunch of noisy trades that aren't necessarily flash crashes. So Pragma in 2017, I think, improved on those criteria. They are explicitly asking for the market to decide to agree on a definition for flash crashes. This is closer, but I'll show in a moment that their hypothesis, this is an undeclared hypothesis that a flash crash is related to a widening bid-ask spread. It is often related in that way, but it's not necessary. So it's predictive, but not necessary to be a flash crash. So I'm going to be combining those two criteria to make what I think is a better criteria in this paper. So as you can see here, this is a discovered flash crash in ADT stock. It happens right around here, about the 78,000th second. So, and as you can see, there is no spread in what's being bid and what's being asked at that time, which is kind of a challenge to most people's explanations for what flash crashes are. It should be that there's a widening here that reflects the lack of liquidity, but in this case, everybody was perfectly happy to trade at rapidly decreasing prices. Two other classic flash crashes that I found. These would both be classified as a fat finger trade. So you can see right down here that at a certain point, there was a poor trade, or an algorithm that was happy to trade at a large bid-ask spread. And then after that, there was a cascade of algorithms which tried to take advantage of that increase in spread. So even though this is a tiny trade, there were several other trades that were executed right immediately afterwards, which made the total volume of the flash crash large enough to be influential. Same thing happened in SMG stock. So in this case, this is even maybe a little bit more classic. There's a large fat finger trade right in the middle here, and then following that, there continues to be a large differential, what Pragma asks for 10 times or so in the bid-ask spread, which incidentally is an opportunity for arbitrage. So if you could identify the flash crashes, then an algorithm could come in and profit off of the arbitrage. So this is my final proposal for what a flash crash should be defined as. It needs to be a large price move. I didn't define it as a multiple of the volatility because nobody knows the volatility off the top of their head. This seems a little bit simpler. It's quick, which is included in Galoob, but not something that Pragma includes. It allows for morning volatility. I just don't look at the first 30 to 45 minutes of trading. There is a strong price reversion, and this is not included in Galoob to its massive detriment. Not including requirement number 4 really makes this research invalid. And then 5 and 6, the length of the runs used in Galoob is not necessary. It's merely a predictor for a flash crash. So you wouldn't use it in making your training set. You would just use it as a potential predictor. The same thing goes for a widening in the bid-ask spread. So these two are not conditions. Okay, so it could be, once you have a catalog of these things, in addition to trying to find indicator variables that are predictive for flash crashes, you could also just use the statistics of flash crashes to try to find correlations. Those correlations, you can see, first of all, this is where the flash crash in ADT occurred, and because data that's reported to stock pickers is smoothed out over, say, 5 seconds, it didn't even appear. So these things, flash crashes, are happening all the time, and nobody knows about them because they're not looking at the microsecond data. So there was a flash crash here which drove the price down to, I believe it was 9 point something or another, 9.35. So it went down from 9.6 to about 9.35 during the flash crash, so 9.6 to about right here. But it didn't fall like that in a macro sense until the next day. So it's possible that the flash crash is predictive of what's going to happen over time. I would need more data to draw such a correlation. Levin tries a sample size of 1 to make such an argument. He says that the number of flash crashes that occurred just prior to a crash in the Treasury bond, which was one of the famous ones that we listed earlier, the number of flash crashes was spiked just prior to that, and that was predictive of a problem in the Treasury bond. And Pragma also argues that flash crashes are not discrete events, that a flash crash in one pair of currencies triggers flash crashes in other pairs of currencies. So in conclusion, in this research, I have located a source of publicly available high-frequency trading data. I have used that source to discover 3 novel flash crashes, which occurred over a week. And those flash crashes could be used as a data set to continue to download information from this website for a couple of months or so. And once you have a data set, you could then try to decide what types of indicators would be good predictors for flash crashes. That would allow you to do things like sell insurance for flash crash predictions, or it's also an opportunity for arbitrage. If you know that a flash crash is coming, then you could use that in an algorithm to make some money. The main usefulness of this research is to expand upon the work of 2 previous papers. Their definitions of a flash crash and Nanex's definition of a flash crash, according to this research, should be amended. Thank you.